right, let's talk about one of the most infuriating things in all of trading. I'm talking about that feeling, you know the one, where the market seems to have a personal vendetta against you. It hunts down your stop loss, kicks you out of a trade, and then, wouldn't you know it, it rockets in the exact direction you predicted. Sound familiar? Well, today we're going to pull back the curtain on exactly why this happens, and, more importantly, what you can actually do about it. I mean, seriously, just picture it. You've done all the work, right? The analysis is solid, the chart looks absolutely pristine, you found what looks like the perfect setup, and you put on your trade feeling pretty good about it. You set a stop loss that seems totally safe, totally logical, maybe just a little bit below a key support level. And then you watch as the price just dips down, tags your stop almost to the penny, and boom, it whips right back around and takes off in your direction. But now you're on the sidelines. It feels personal, right? Like someone's watching you. Okay, so I'm here to tell you, you're not going crazy. This isn't just bad luck, and it's not just paranoia. What you're experiencing is actually a feature of the market, not a bug. It's a fundamental part of how these things are designed to work, and it's especially true in the wild, fast-paced world of crypto. So to really get what's happening here, we have to look past all the noise. You know, the headlines, the hype on social media. We need to understand the real game that's being played, moment to moment. And that game, it's all about hunting for one thing and one thing only: liquidity.
So what even is liquidity? Well, in the simplest terms, it's just about how easily you can buy or sell something big without wrecking the price. Look, for you and me, buying a bit of crypto is no big deal. But imagine you're a whale and you want to buy, say, $100 million worth. You can't just slam that market buy button, right? You'd send the price to the moon and get a terrible entry. So to fill that huge order, you need to find a giant pool of people who are willing to sell. It's not even necessarily evil. For them, it's just a business requirement. And this right here, this is probably the most important thing you're going to hear today. We're often taught that price moves towards fair value. Forget that for a second. In the short-term, moment-to-moment world of trading, price acts more like a heat-seeking missile. And its target, the biggest, closest pool of liquidity it can find. And guess what one of the biggest, most predictable pools of liquidity is? Yep, you guessed it. It's your stop loss. You see it as your shield, but to the biggest players in the game, it looks an awful lot like bait. I mean, it really is all about perspective, isn't it? When you look at your stop loss, you see protection. It's your safety net. But when a whale or a big institution looks at it, they see something totally different. They see a future market order just waiting to be triggered. It's a promise from you to sell at a specific price. For them, that's not protection. That's fuel. It's the liquidity they need to fill their own giant positions. And here's the real kicker. Where does everyone learn to place their stops? We're all taught the same textbook rules, right? Put it just below support or just above resistance. And what's the result? Well, you get thousands upon thousands of these stop orders stacked up in the exact same super predictable places. It creates what the big fish in the sea see as an all-you-can-eat buffet of liquidity. So how does this hunt actually play out? It's almost like a 5-step playbook. First, you've got the initiation. The whale starts selling just enough to nudge the price down towards that big cluster of stops. Second, momentum. Other traders see the price dropping, they get scared, they start panic selling or shorting, and that just adds more fuel to the fire. Third, the cascade. This is the knockout punch. The price hits that big wall of stops, triggering them all at once. This unleashes a massive wave of forced selling, causing a super fast price flush. Fourth, absorption. And who's waiting at the bottom of that crash with their buy orders open? The whales. They're just calmly soaking up all those cheap coins from the people who are forced to sell. And finally, number 5, the reversal. Now that the pool of sellers is all dried up, the downward pressure is gone, and whoosh, the price snaps right back to where it was or even higher. Now look, this kind of thing happens in every market. Stocks, Forex, you name it. But in crypto? Oh man, it's on a whole other level. It's way more aggressive and happens a lot more often. Yeah, in the crypto space, this isn't just a little tremor. It's a full-blown earthquake. And there are really 4 key things that act like magnifiers, turning a regular stop hunt into something way, way more violent. First off, you've got 24/7 trading. This means there are these quiet periods, like over the weekend when volume is low. It's just cheaper and easier for a big player to push the price around then. Second, extreme leverage. The kind of leverage you see in crypto is just insane, and it creates these huge predictable clusters of liquidations right next to all the stop losses, making those liquidity pools even bigger and more tempting. Third, the liquidity is fragmented.
It's spread out over dozens of different exchanges, which means the order book on any single exchange is thinner and easier to manipulate. And finally, you have lighter regulation. There just aren't as many safety nets, like the circuit breakers you see in the stock market, that can stop a free fall. Okay, so the market is a shark, and it's always hunting for liquidity. Does that mean you're doomed to be its next meal? No, absolutely not. It just means you have to stop acting like a helpless fish and start thinking like a smarter creature. It's time to change our strategy. All right, principle number one, and this is maybe the most important. Stop putting your stop loss where everyone else puts theirs. You have to get out of the herd and start thinking differently. So instead of just dropping it right below that obvious support line that literally everyone on the planet can see, ask yourself a much better question. At what price is my entire idea for this trade wrong? Not just a little bit wrong, but completely invalidated. This usually means you have to zoom out, look at a higher time frame, like the daily or the weekly chart, and find a really significant low to place your stop under. You've got to give your trade room to breathe and survive all that short-term noise.
Okay, and that leads us straight into principle number 2, which is critical. If you're going to use a wider, smarter stop loss, then you absolutely have to adjust your position size. It's all about managing that risk.
Here's how the professionals think about it. First, they decide their risk. I will risk 1% of my account on this trade, period. Then they figure out the logical place for their stop based on the chart. And only then do they calculate how big their position can be to match that 1% risk. See, most retail traders do it completely backward. They pick a huge position size first, and then they're forced to cram their stop loss in way too tight, which is basically painting a giant target on their back. All right, principle number 3. This one's a bit more advanced, and it's probably best for people who are swing trading on higher time frames, not day trading with tons of leverage. It's the idea of a soft stop. So instead of putting an actual stop loss order on the exchange, you just set a price alert at that level. When the alert goes off, you have to manually pull up the chart and take a look. You ask yourself, is the price actually breaking down with real momentum, or was that just a nasty fast wick that's already bouncing back? It lets you use context to make a decision. Now, I have to warn you, this takes a ton of discipline. You have to be able to pull the trigger and sell without hesitation if the breakdown is real. It's not for everyone, but it can save you from getting wicked out of a perfectly good trade. And finally, we get to principle number 4. This is where you really level up. Instead of just trying to avoid the hunt, you can actually learn to spot its tracks and maybe even use it to your advantage. So what does the footprint of a hunt look like on a chart? You're looking for a really sharp, violent wick, usually with a big spike in volume. It stabs down below an obvious low or up above an obvious high, and then it gets rejected hard and snaps right back into the range it came from. For the person who got hunted, that wick is a tragedy. But for you, the observant trader, that powerful reversal can actually be a fantastic entry signal. So the next time you get stopped out like this, try to remember, it's not personal. The market isn't some evil villain that's out to get you. It's just a cold, impersonal machine, and it's doing exactly what it was designed to do, hunting for liquidity. Your job as a trader isn't to fight the machine. It's to understand how it works. It's about figuring out where those deep pools of liquidity, those danger zones, are going to be, and then making a conscious decision not to stand there. So I'll leave you with this question. Now that you can see the game for what it is, where are you going to stand?